that, allow me to explain how is your income account affected. Your income account is affected in this manner. Whenever your incomes are increasing, they will be affected on the credit side. So if you see an income account being credited, you are referring to a situation where it was an inflow of cash, or it will be an inflow of cash in the future. Let us start with your sales account. Whenever we sell goods, whether it's cash or on credit, if you sell goods on cash, two accounts will be affected. You will have bank being debited and you'll have sales being credited. Remember, your income account increase on the credit side, so your sales will be credited. Then I won't go into the matching concept where you say where your sales debit bank credit sales, and the matching concept account will be your cost of sales being debited and your trading stock being credited. I won't go into that. I'm just explaining the basics of how incomes are affected. Rent income. Okay, here under sales, sorry about that. With your sales, let's assume that we sold goods on credit. Two accounts will be affected: debtors control and sales. Debtors control is an assets account. It will increase because we are having more customers buying on credit, or our balance that we expect to recover from customers is being increased because we are continuing to sell on credit. Therefore, an account that we need to record will debit your debtors control and credit your sales accounts. So both are increasing, but they are affected on the debit side and they are affected on the credit side. Double entry system. Rent income. If we are having a tenant, then this particular tenant is paying us an amount of money. This will be regarded as rent income. So two accounts will be affected. You will debit bank its money in, then credit rent income, because your income account is increasing. But what will happen in a situation where your rent income is not received, but we have earned it? So in that case, let's say we are approaching, or we are at the end of the financial year, and 1 month of rent income is not received. We will record rent income because we'll be using an accrual basis. I will still present a lesson where I'm differentiating between a cash basis and an accrual basis. But for now, for simplicity purposes, let us assume that we do understand the issue of accrual basis, but I will explain in short so that my example or what I'm trying to say makes sense indeed. So with accrual basis, we have earned that amount of income but not yet received. As I was saying, we are at the end of the financial year, but we have received a rent income or rent incomes for 11 months. So we will record this rent income for 1 month. That will make 12 months, simply because we are using an accrual basis. So two accounts will be affected. It will be accrued income or income receivable and credit rent income. Discount received. If we received as a settlement discount, meaning that we were owing these creditors, so they gave us maybe 10% of what? Of a discount, meaning that if we were owing 5,000 rand, we are now going to pay 4,500 because they've given us a discount. So account will be, you will credit, you will debit your creditors control, and you will credit your discount received, because with discount received they are referring to an income account. It is not money in per se, but we account for the issue that we are paying less than what we are supposed to pay. So for that difference that will remain, we will regard it or will treat it as a discount received so that the balance is settled. That is what we refer, or that is what we mean, or that is how we're supposed to treat our discount received. Commission income. Commission income, it is where we are an intermediary or a middleman. We have introduced a particular company to its customer. Then once this transaction is successful, we earn a commission income, an income that, or an income for the purpose of making sure that these particular parties meet and they enter into a contract or a transaction. Then we get a certain percentage of an amount of money where we say it's our commission, because we introduced these parties. We introduced a seller to a buyer, and we get a commission income for that. So two accounts will be affected. You will debit bank as your asset account, and you will credit towards commission income. Then you record your amounts. Interest income. Interest income, it might be an interest from fixed deposits, it might be an interest from the credit balance in our bank account, or a favorable bank balance. We refer to it as interest income. Again, you'll debit what? You'll debit bank and you'll credit interest income. Trading stock surplus. Trading stock surplus, it is where at the end of the financial year, you will realize that you are having more stock than what your accounting books are telling you, meaning that the stock that you found in your storeroom or in your warehouse rather is higher than the amount that is on your ledger account or on your pre-adjustment trial balance with regards to your financial statement. Then you try to compensate for that increase in your balance. Then we call it a trading stock surplus. So again, two accounts will be affected. Remember, in this case, it is not money in, so bank is not affected, but trading stock will be on the debit side, an increase in assets. But this increase, it doesn't mean that we bought more trading stock, but we are adjusting. It's an estimate. We are adjusting what our trading stock balance, then it's called trading stock surplus. Once you say trading stock surplus, it's no longer an asset but an income account. So those are two different accounts. Provision for bad debt adjustment decrease. So with the provision for bad debt adjustment decrease, it means that, firstly, let me explain provision for bad debt. Or firstly, let me explain the term provision. A provision is an uncertain amount of timing. So you are unsure of one of the two here. Is either you are unsure of an amount that you're going to pay, or you are unsure with regards to when are you going to be liable to pay this amount of money. So what will happen is that we will set an amount of money aside for bad debt. It means that through our assessments, through our continuous observation, we have discovered, or we suspect, or we have a reason to believe that these particular debtors won't pay us as per our agreement with them. So we create an account, or we set an amount of money aside to make sure that should these debtors fail to pay and we are forced to remove them from debtors control into bad debt, there's an amount of money that we are going to use to compensate for such loss. So with the provision for bad debt adjustment, we are referring to a situation where we have set aside 5,000 rand, but our bad debts are 2,000 rand, or there is now an indication where we say we need to reduce this amount of money simply because debtors that we assumed or that are presumed that they are not going to pay, they are now paying. So we have set more money aside. Then we need to bring it back. That is where we are reducing the provision for bad debt. If we are reducing the provision for bad debt, that amount of money that was set aside, now we are utilizing it in our business. It means that it will become an income because we have set aside more than what we were supposed to set aside. That amount of money from our funds or from an amount that was set aside back into the business, we treat it as an income account. So it's called provision for bad debt adjustment. Next slide.